Welcome to part three of our Impact Capital Showcase, Bridge Financing, Fast and Flexible Capital to Keep Impact Moving. I'm Sharon Murray, Director of Impact Capital Programs at ReFED, and we have thoroughly enjoyed co-hosting this webinar session with our friends at CapShift and have been really thrilled with the positive feedback from so many of you. So thank you. Each session has aimed to connect funders and investors with real opportunities to move capital towards impact. And today we intend to end the series with a bang as we take a look at how bridge financing can cover critical gaps to support mission-driven companies and ensure that their critical work continues without disruption. As a reminder, if you have missed any of the sessions or want to share them with your colleagues, you can find the recordings on our YouTube channel, as well as in your inboxes. Apologize for anyone sick of hearing this, but in case we've got some new folks on the line, I'm going to tell you a little bit about ReFED and our partners at CapShift. ReFED is a US-based nonprofit working to catalyze action across the food system to stop wasting food. A key part of our work is supporting funders and investors to deploy capital strategically and confidently into high-impact food waste solutions. We do this through our Food Waste Funder Circle, our tailored advisory support, events like this one, and a whole lot more. So if you're interested in learning more about how we can support your giving or investment strategy, please do reach out. Our co-host CapShift empowers financial institutions and their clients to activate capital towards social and environmental change. They leverage their technology platform and industry expertise to work with partners at every stage, from discovering impact investment opportunities to portfolio advisory and post-investment reporting. CapShift's clients, which include over 45 private wealth and charitable institutions, have mobilized over $1 billion towards solutions across the 17 UN SDG thematic areas, which very impressive. And for the third and last time, I promise, we've got some disclosures. So please take a look at the text on the slide and note that neither CapShift nor ReFED are recommending an investment or recoverable grant to any offerings being discussed today. And this conversation is not a recommendation of any products or services from CapShift or ReFED. Thank you to our lawyers for that. All right, we are honored to be joined by leading funders leveraging bridge financing to drive positive change. First, we're going to hear from Caroline Bresson, CEO of Open Road, who will share how funders can make a big difference for mission-driven companies by providing short-term financing to cover gaps between funding rounds, grant distributions, revenue milestones, and more. Caroline's going to be followed by pitches from Aaron Davis, co-founder and COO of Enduring Planet, Namaka Ikegwanu, founder and CEO of Cold Hubs, and Dan Kurzrock, co-founder and CEO of Upcycled Foods, Inc. Each speaker will share about their organizations and provide examples of bridge financing in action. And they are quite exciting, so I hope you're all ready. Then we're going to bring everyone together for an audience Q&A and call it a day. So with that, Caroline, over to you.
Thanks, Sharon. If you could jump me forward one slide. I'll kick us off just by kind of sharing Open Road's winding journey over the years. I know ReFED works with a lot of family offices, and so sharing our start within a family office. Our founder, she didn't have any sector geography passion, but saw that the social sector wasn't working as well as it could be for organizations doing the hard work. And so about 12 years ago, we started off making one-time grants for unexpected roadblocks. And that was an urgent need, writing 100K checks as really as quickly as we could. Over time, we saw that it wasn't just that there were gaps, but there were also a plethora of timing issues. And so we started to make recoverable grants out of our donor advised fund as bridge financing. And I'll talk about what that is in more detail in just a minute. From there, we realized that our DAF couldn't move as quickly as we wanted to be able to solve the pressing needs of the borrowers we wanted to work with. So we took kind of the work on the family's balance sheet and started making loans. did around $30 million of loans on the family's balance sheet and realized that the demand was much bigger, and raised our first external fund in 2020, right at the beginning of COVID. We closed out that fund earlier this year and launched a nonprofit, Open Road Impact, whose goal is to unstick capital in the social sector. And we do that by providing bridge loans directly to companies and nonprofits. We also create mini open roads when there are urgent issues where capital needs unsticking, like with the USAID funding freeze. And then we also work in advocacy with our founder, trying to encourage other family offices to get into impact first investing. Next slide, please. So, bridge financing, bridge loans in a nutshell. Um, uh, it is what it sounds like, taking you from point A to point B. I do want to make one important distinction between bridge financing and venture debt, which you might hear of as well. Bridge financing, a bridge loan, is you are making a loan to a future cash flow, a contract, an money round, investment round coming in. You know what the money is that's going to repay you when you put the money in. Venture debt, on the other hand, can be a bit longer term and is also kind of more uncertain in terms of where your repayment is coming from. And can be quite expensive depending on where you're getting the capital. So some of the pros of bridge loans is that it can be really fast, and solve that urgent cash kind of a cash crunch issue. In kind of mainstream finance, some of the issues with bridge loans is that they can be very high interest rates, sometimes upwards of 20 or 30%, and also tend to be dilutive. So a lot of these bridge loans can sometimes come with kind of an equity kicker, which kind of puts you on the other side of the table as the entrepreneur. Next slide, please. You see bridge loans all over capital markets. When we first got into this, I wish I could have said, "Oh, here is this impact investing bridge lender that I can go and replicate this model," but it didn't exist. So we really looked to kind of mainstream finance to see the different uses, and they are varied. Certainly a lot in early stage venture, but you see it all the way up for major acquisitions. You'll see JP Morgan facilitating a multi-billion-dollar bridge loan so that a large corporate can acquire another corporate, all repaid within a year. Next slide, please. One of the, I think, great examples of bridge lending from the social sector was during COVID. Ford Foundation Nonprofit Finance Fund set up a COVID relief fund that gave bridge loans to New York City nonprofits. And it was an incredible accomplishment. They mobilized over almost $100 million. The thing that sticks out to me the most, and I hope you take this away, is they set it up within a week. They agreed to all of the terms within a week of kind of the New York shutdown with COVID. In impact investing, sometimes we let perfect be the enemy of the good. And for bridge lending to work, you really have to move quickly. Otherwise, the urgent need is not addressed. Next slide, please. So I want to dig in here a little bit, because a lot of people ask, like, why bridge lending? You're only coming in for 6, 8 months. Like, are you really providing that much value? And in our research, the answer we've come to find is yes. Almost 80% of our loans go to cover operating expenses. So literally keeping the lights on for these organizations. And I just want to pause for a minute because, put yourself in an entrepreneur's shoes. You've got great momentum. Maybe you've got some big purchase orders. You've got investors that are interested that think you're doing great work, but you have maybe a month, maybe 2 months of cash in the bank. You have to keep your team together. And then you have these big investors that are saying, we're going to give you multiple millions of dollars, but you're going to have to grow 100% when that money comes in. But I can't give you that money right now because we've got all of these legal documents to get through before I can write my check. 40% of the time, our bridge loans are going to cover this legal documentation phase that can take as long as 8 months. And so getting that money when you need it, when you can keep your team together, is really the value of a bridge loan. We think about it as accelerating impact there's no way we're going to hit any of our climate goals if these kinds of companies are sitting on their hands for 6 months waiting to sign legal documents. You have to get the money in their hands today so they can keep growing and scaling at the pace that all of us want them to. Next slide, please. So where could bridge loans fill gaps in the market? These are just a few examples. Bridges to mission-driven organizations, companies, and nonprofits that have incoming grants, equity or debt. We've done a number of bridges to state government contracts that are reimbursable, where they have to do the work before they actually get paid. Working capital receivables, you get this large unexpected contract, but again, don't have the money kind of upfront to be able to do the work to get paid. And then we've seen it more also in kind of project finance, where there is kind of a gap between the initial pre-development funding and when the larger capital comes in. Nature-based solutions, I think, is also a pretty exciting place to explore this, just because there's so many disparate actors around a table that are coming together trying to come up with kind of a longer-term financing solution. That's where bridge financing can really add value. And then lastly, intermediary funds have the same issues that entrepreneurs do. Trying to get to first close, for example, it can be really helpful to get a bridge loan so that they can get their first few deals under their belt. Next slide. So this is just kind of the structure of a bridge loan that's going towards bridging to an operating company, which I think we'll hear two examples of today. So when we come in, when Open Road comes in, there's typically a term sheet. So there is an equity or debt investor that says, I like this company, I want to invest. Sometimes they've even approved it at their investment committee. Now we have to do legal documents. And that can take, like I said, as long as 8 months is what we've seen in our portfolio. Making this bridge loan allows the company to pay their operating expenses, perhaps invest in some sort of CapEx if that's their structure. And then once that capital comes in, the funding is repaid. Next slide, please. So one example of this during COVID, a brand that many of you might know, Open Road supported Numi Tea. They were in the midst of securing some longer term debt, but needed to kind of pay their suppliers to be able to fill all the orders they had on their plates. So Open Road made them $1 million loan. And while they were doing all of the kind of legal documentation with Community Vision, which is also a great partner, and that allowed the company just to continue operating as usual. I think the best form of a bridge loan is one that the operators don't have to think about while they have it, right? They just get to run their business as usual instead of having to spend, half their time, most of their time focused on where kind of that next month's payment is going to come from. Next slide, please. So bridge loans, like I said, can also be used to help an organization's cash conversion cycle. And so what I mean by this is you get a purchase order, you can deliver on it. A lot of times these companies don't have the working capital they need to just be able to build their product, whatever that product is, and then sell it and then get paid for it. And so this is really kind of the bread and butter of how businesses work. Many of you might be aware that American banks specifically aren't really making small business loans post the financial crisis. And so bridge loans can come in at these step-up moments of growth when they have kind of an unexpectedly large purchase order that can be delivered on with this cash infusion. I think of a bridge loan as kind of a lead-in to a working capital loan relationship. And so Open Road also makes working capital loans that are longer term at times. And the bridge loan is really the way for us to get to know the organization. They can deliver on this large contract, and then we can give them kind of a longer term loan to manage future contracts going forward. Next slide, please. So one example of this was Real Fruit, a Nigerian food processor. They focus specifically on taking some of the waste from pineapples and selling them in kind of the dried pineapple packages in Nigeria. They had received some finance to grow their factory, but there were some bureaucratic delays that slowed that down. And so in between, Open Road gave them a small 200K loan so that they could fulfill the purchase orders that they had while they were working towards this longer term growth opportunity. Next slide, please. And I'm moving kind of quickly. There's a lot of information here, but I will share the slides afterwards. Getting the structure right for bridge loans is critically important. I joke sometimes that uh, bridge loans are more work for less money than any kind of loan out there. So Open Road, we do around 30 deals a year. We want our money to stay out for not that long. So we're not earning interest for that long on the money that's outstanding. That's one of the reasons we're a nonprofit because we see there's a gap in the market. But when USAID was shut down earlier this year, even our current structure wasn't flexible enough to be able to take on the uncertainty that existed in the market around USAID. And so we raised a recoverable grant that was 0% and said to our funder, we think we can probably get 50 to 75% of this loan back. But we were going to make loans to a specific portfolio at USAID called the Development Innovation Ventures team, where there had been work completed but not paid for from the US government. And so we hired three ex-USAID people to be able to help these organizations submit the paperwork so that as little work had to be done as possible. And then made 0% loans to them so that they had the cash to kind of keep their team on hand while they figured out what their next step was. And the purpose of this illustration is to say, you really have to think about the level of uncertainty in the work that you're doing. If you're doing your first bridge loan, maybe out of a DAF, for example, and it's really not clear, what the outcome is going to be, a recoverable grant is a much better option than maybe a loan, just because it allows more flexibility on the back end. And I'm really surprised and happy to say that 85% of these loans have been repaid to date. Most of that is due to the fact that there were former USAID people on our team that were helping submit the paperwork. Next slide, please. All right, so getting the process right is just as important as getting the structure right. I think I said this at the beginning, but a slow bridge loan does kind of loses all the additionality that you're hoping for. The value add of a bridge loan is timing, and so you have to be able to set up a structure that is fast and flexible. We aim to disperse within 6 to 8 weeks. We focus a lot of our team's time on how to get that number to be even shorter. And then we also have to do quite a bit of active portfolio management to kind of stay on top of where things are because this is just a very uncertain market. So, things take longer quite frequently. That doesn't mean that something is going wrong necessarily with the company. It just means that the transaction is taking longer to come together. And so, again, kind of having these rational expectations up front around the structure, as well as the process on the front end and the back end are really critical. Okay, and so just wrapping up quickly, happy to talk more for anyone interested in learning about bridge lending. Open Road is a nonprofit. We raise both grants and debt to unstick capital, and I will turn it over to Erin.
Thank you. That was such a wonderful introduction to bridge financing. It's as if this was all perfectly planned. So my name is Erin Davis. I'm the co-founder and COO of Enduring Planet. Today I'm going to talk about the Enduring Climate Fund 2 that we've set up as a credit platform for the new climate economy here in the US. Okay. So just a little bit about our team. I have spent the last 10 plus years in impact investing and lending into climate tech. I previously co-founded a company called SEMA Funds, which is an impact fund manager focused on the off-grid solar sector in Africa and South Asia. I've launched three funds at SEMA, raising money from institutional and private capital, including MetLife, AXA, and Church Pension Group. And so, kind of bringing that expertise over to the US climate space. My co founder, Dimitri Gershenson, has spent the last 15 years in climate and tech and notably 5 years at Facebook deploying catalytic capital to impact fund managers um, to get funds going, especially in emerging markets. My right-hand man, Suhail Darvesh, is our head of credit, and he has about 20 years of banking experience. And then Josh, our CTO, has 20 years of experience growing brands and in the product space. So together, we're putting together this, very technology-driven finance platform to get capital into the hands of climate entrepreneurs. We know there's great opportunity, 100K plus companies with a huge gap in the market, and we're excited about this opportunity. As Caroline mentioned, and I guess I don't have to go too deep into this, but working capital is a constant challenge, especially climate startups with different R&D requirements, lumpy revenue, slow sales cycles. Traditional lenders just aren't there. And so we have this huge opportunity to provide this type of bridge finance to substantial contracted receivables. So we see the line in sight of the repayment mechanism, and we're willing to lend off the back of that. Today, we've done about $30 million worth of investing into this space, and this is close to 90 deals in the last 3 years. We do this non-dilutively, so we don't take any equity kickers. And we try to take, minimal collateral. And then we leverage our technology and proprietary underwriting to do this very quickly. Um, we don't see a lot of other opportunities on the market. So, early stage VC is very dilutive. Bank debt, if they can even access this, is extremely slow. Venture debt is pricey, and the likelihood of earlier stage climate entrepreneurs being able to unlock this capital is very low. And so that's where we really felt that we could come in and unstick some of this capital. So we provide fast, flexible, founder-friendly type of capital. Right now, we're doing 100K to $1 million loans. Our interest rate is in the 15% range, and we're really looking to drive this down by raising catalytic capital from impact investors. We're very transparent with our terms, and our borrowers can see all of these terms on our website. We offer three kind of products. So a pure government grant advance. So this is 6 to 12 months advancing against state, federal, municipality type grants. PO advances for government contractors. And then also term loans. So essentially, we are bridging against commercial contracts. And we use our technology that we've built to do this very quickly. Our borrowers submit an application. they do this in about 15, 20 minutes. We require that they connect their banking and accounting platform so we can quickly assess their financial situation. And then we also, I just want to highlight kind of our low risk servicing. So, um, I think people are nervous to lend to earlier stage entrepreneurs, and one of the ways that we reduce some of that risk is by requiring ACH debit, right? So that when we see those inflows come in from the contract, we are automatically pulling our repayment and not waiting for the borrower to repay. So in the food waste space, we've done a few of these loans. Compost Colorado is a great example that we've had a long relationship with. We've done 3 loans with them on several different grant contracts, especially with the Colorado Department of Public Health and Environment. So this was a 12-month loan that enabled them to purchase 2 large in-vessel compost systems to provide more capacity for the North Denver area. And this is kind of the chicken or egg situation where they've won the grant, but they have not been able to actually execute on the project because they don't have the capital to buy these $100,000 vessels. So we provided the capital up front. They installed the vessels, and then once the Colorado Department of Health is satisfied that they're installed correctly, they get paid, and then we get paid. Another loan that we've done is with Myland Agriculture. They have a Texas A&M AgriLife funding, and this is a 12-month $500K loan that really gives them working capital to pursue their project. As I mentioned, we've closed 80 plus deals. I'm hoping to get to 100 early next year. And this number is ticking up in terms of millions of dollars. We source pipeline from everywhere, inbound and outbound outreach. A lot of it is just kind of building our brand and word of mouth. And we also have unique sourcing partnerships with VCs and other accelerators, co-lenders, and other databases. I think one of the elephants in the room is this administration and the political change. And what we've seen so far is obviously some disruption, but we haven't seen the total decimation as I think some would like to think. So our companies in our portfolio, their grants and contracts continue to pay out. They haven't been as affected. And we made the decision early this year to focus a little bit more on state programs. California is doubling down. New York has a huge procurement program. And then we've also ratcheted up our term loans against commercial receivables to diversify our portfolio. So the fund itself and the opportunity for investors is to invest into a $20 million fund and earn a 10% coupon. We, Enduring Planet, put in 5% of the first loss capital, and then we've also procured a guarantee from CIGP, and that's a consortium of foundations providing unfunded guarantees to kind of mitigate some of those hesitations of investors during this political time. So the term is relatively short term. Investors can invest 36 months, and we plan to do about $80 million more of total investments. I can tell you more about the guarantee another time. But I really just wanted to highlight why I think it's important for investors to participate to enable cash flows for these critical climate solutions, to address the gaps left by traditional lenders, and to accelerate the speed that climate entrepreneurs are able to deploy capital. So your investment will earn a 10% coupon. You could diversify an equity heavy portfolio. And for catalytic investors, you could also help us to drive down our cost of capital. So with that, I would love to take any questions. This is my information, and I'll pass it over to Nemeka.
Thank you very much, Erin. Let me quickly share my screen. Just quickly. All right. Hi, everyone. Thank you very much. I will be talking about our work at Cold Hubs addressing food loss using clean energy and cooling as a service business model, and our urgent, compelling need for a bridge loan. Well, first of all, a quick introduction to myself. My name is Ndameki Kegwon. I'm a farmer, a radio presenter, and a social entrepreneur. I started our first venture, the Smallholders Foundation, which is a non-profit that did agricultural radio broadcasting in 2003. And in 2007, we built a community radio station where I spent 30% of my time discussing about agricultural information. And then the other 70% really in the field, trying to identify challenges and opportunities really facing smallholder farmers. And it was really in the course of my travels through the length and breadth of Nigeria that I discovered the problem of food spoilage, especially around fresh fruit and vegetables due to lack of cold storage at key points along the food supply chain. And the Rockefeller Foundation in 2014 wrote a report about food spoilage affecting an estimated 93 million smallholder farmers and food supply chain actors. But really, when you travel on Nigerian highways, you usually see fresh produce dumped on the roadside because we do not have the infrastructure to secure the food and extend the shelf life. And really, that problem was illustrated by the FAO when they turned out this report about continents where there is massive food loss due to inefficient production, post-harvest processing and distribution systems, comparing it to continents where they have food waste, usually discarded by consumers because there's a lot of food. So Africa came out very massive in that report, showing that there is massive food loss occurring in the continent due to lack of infrastructure. And then our food systems are organized in outdoor food markets, which do not have any form of energy supply. And so when in 2015 we founded Cold Hubs, we built it as a company that designs, builds, and operates 100% solar-powered working cold rooms, ranging from 3-ton facilities for small food markets to 100-ton cold storages entirely powered by solar for large-scale food aggregation centers and also markets across the country. And then we started building out these cold rooms in different markets across Nigeria, making sure that each of them meets the weather conditions of the location that we will install, and also integrating Aru-290 refrigerant gases to make sure that they are really green and clean, and integrating them with state-of-the-art remote monitoring, collecting data on solar irradiation, ambient temperature, door openings, and even going further to integrate video cameras in each cold room so that we can see as door is opening, food coming in and food going out in each cold station. But really, in this part of the world, you can have the most beautiful infrastructure. Without education, it's very difficult to sell the infrastructure. So when we realized it in 2015, we built education around the infrastructure, spending 3 days with market vendors, smallholder farmers, teaching them about post-harvest management of fresh produce. But really, the goal is to make sure that the cold rooms are used to extend the shelf life of food, fruit and vegetables from 2 days to 21 days. Also have dedicated cold storages for meat storage, dedicated cold storages for fish and seafood, and also for milk collection centers. And the cooling as a service business model, really, which we introduced, was really to democratize cooling space, making sure everybody has access. So for 120-kilogram plastic crate of produce, vendors pay the equivalent of 21 US cents to store per night. And for a 5-kilogram stainless tray of meat or fish, market vendors or farmers pay the equivalent of 35 US cents to store per night. This model actually liberalizes cooling space and makes it accessible to everyone with no need to invest capex to own the infrastructure. And our operations are driven by ladies who are hub operators and market attendants, and their goal is really to receive goods from customers, register those goods, and then collect user fee from all the customers. So we are now a 10-year company in Nigeria. We've saved more than 31 million kilograms of food from spoilage, serving 11,000 users, created 100 jobs for women, and saved 3.9 million kilograms of CO2, running our facilities entirely on solar. And there is a powerful publication by International Food Research Institute showing that food stored in cold storages maintain their nutritional content when compared to food stored outside. We're in 28 states of Nigeria and preparing to do international pilots across Sierra Leone, Kenya, and the UAE, and then introduced logistics for end-to-end cold chain, moving tomatoes at the moment, producing plastic crates for packaging of these tomatoes and other fresh food and vegetables, and also launching Cold Connect app, which enables everyone to know where the cold rooms are and other refrigerated space. A team of 121. Together, 3 years ago, we launched a Series A round, trying to raise $8 million to scale our work in Nigeria. And we were fortunate enough that that round had one commitment from King Philanthropies, California-based foundation that invests in companies at the nexus of energy and climate. And KP committed 4 million, of which they disbursed 2 million. But sadly, KP has now entered into a liquidity issue on their endowment, and they cannot be able to disburse the balance 2 million until 2026 or 2027. We also have conversation with other debt investors like Electrify and Oiko Credit ongoing as part of the round. And really, the funding is for us to scale our work in Nigeria. But sadly, because of the situation that KP has actually put the company in difficult circumstance, we are now looking for a bridge loan of about 500,000 US dollar. And it's a compelling need because we have a Series A round, and then we need to close out and pay the legal fees, retrieve 2 containers that have been stuck on a seaport of Nigeria with our goods, our equipment, and also close out on a land at Nigeria's largest fresh fruit and vegetable market, Mile 12 Market in Lagos, and install a 100-ton cold room in that location. And so the company has been funded by, a lot of impact investors over the past 10 years, development organizations, bilateral and multilateral. And that's really one of the cases that we are making, that the company has a track record of delivering on impact and managing resources judiciously. And in the past, we've been able to repay one concessional debt extended to us by Olon Energy Impact Investors. So let me quickly pause here and pass the presentation to Dan Kuzrock of Upcycle Foods. Thank you.
Thank you, Nemeka. What a tough acts to follow here, but my role to bring us home. So let me just share our screen. Thanks to everyone who's here. My name is Dan Kurzrock. I'm the co-founder and CEO of Upcycled Foods, Inc. And I'm going to take you through another case study, which echoes some of what Nemeka experiences, but also more specific, our experience is more specific to the U.S. and kind of the impact, VC environment, some non-traditional financing routes we've taken over the years. First, our company. What do we do? We are in the business of supplying upcycled ingredients, so ingredients that are made from food loss and food waste streams, and uncovering the value from those as B2B ingredients. And then we also have a innovation services lab, which was actually the product of some of the some of our financing journey, and I'll get more to that, but we're essentially now helping other companies turn their food loss and food waste into profitable and impactful innovation. Quick snapshot of the company stage. We have developed IP over the years. We've got patents filed and granted, some still pending. We've commercialized products. We're revenue generating. We have customers that include logos that that you would recognize, and we've been scaling this business for over 13 years now, developing a lot of expertise on what it takes to take food loss and food waste and create it into scalable ingredients. I'll share a bit more about specifically on that, but also just kind of centering our mission, which is all about better aligning the food we eat with the planet and people we love. So we're for profit, we're B Corp, and we have mission at the center of everything that we do. The upcycled innovation model is all about identifying overlooked and undervalued food waste streams that are being left off the table. So as opposed to surplus and kind of farm level ag waste of what you would typically consider as food waste streams, we're looking at byproduct streams, side streams, things that are maybe not being measured as food today, but should be, because with processing innovations we can develop, we can actually bring some of the nutrients that are in many cases concentrated in those streams forward as novel ingredients or substitute ingredients for at-risk commodities. We started with a product called Regrained, which is made from brewer's grain. It's a high protein, high fiber ingredient. It reduces carbon footprint, no land use, no water use, and it's like a fortifying ingredient that can get used into baked goods and snacks. And as I mentioned, I started this as an experiment with home brewing, but we've over the years have developed it into a scalable ingredient platform. In the intervening years to develop the market, we actually launched some of our own consumer products, and we've now sold into multinational food companies with this ingredient. And then, as I mentioned, most recently, our business has evolved to have this innovation lab component. I spoke about this, but kind of the point of this slide is that we started by looking at brewer's grain, but then we started looking at other opportunities from around the world. So just as one case study of that, cacao and the fruit, from the cacao, working with a company around developing a syrup from that, and then helping customers, like Fee Brothers who make bitters, for example, develop a product, using that. And so this is kind of what we do in action here. And with the lab, we've had the opportunity to work with food and beverage brands and manufacturers, but also really interestingly, in the last couple of years, some commodities boards as well. All about kind of trying to help create the rising tide of taking this innovation model and applying it to sectors more at a system level. So specific to this, the topic here today, our company over the years has had a pretty non-traditional fundraising route. I mean, in the early days, we were just kind of credit card financed, and then we did as early as 2015, we did our first kind of Kickstarter type campaign to get some products out. And we've just always tried to raise the money that we needed when we needed it. And so we did a couple community rounds, which has been a really important aspect of our fundraising, where we, for example, hosted a WeFunder, and our customers and just community could invest as little as $250 in a convertible note. We had some put in up to $100,000, on that. So this is a really effective alternative financing vehicle for us. We've also taken strategic capital from groups like Griffith Foods and Wilson Coors, that are relevant to the value chain of the solutions that we're developing. And then when it came to 2022-ish, we were ready to do a Series A that I'm going to talk more about, that resulted ultimately in really needing some bridge financing. And I'm going to talk a bit about how we, what we did there. So starting with, when you're an entrepreneur, that's ready to kind of take the next phase of the business, you've got your plans, and then you've got reality. So I just wanted to, I dug up an old deck and pulled in what we were pitching in 2022, and where we're taking the business. And things were really exciting, for us, and we were really excited to put the plan into action. We were raising a $5 million round. And we actually found an impact VC to lead that round. Signed term sheets, everything was looking at just as it should. But unfortunately, what ended up happening, and this sounds kind of similar to something that Nemeka is unfortunately experiencing. The lead investor, we it came to light, was also having some issues, and in our case, it was closing the fund. And with the lead investor falling through, the whole Series A, as we had planned, had fallen through. We had the 5 million committed, and we ended up kind of in this no man's land, because as a early stage, but kind of scaling, we were beyond like a pre-seed stage. We weren't quite kind of in the beginning of a growth stage, and our business, being in B2B ingredients, has long sales cycles. Those long sales cycles result in typically partnerships, but not really in the sense that we have actual binding offtake agreements that are what a traditional like lender would be looking for. And then, yes, we have some assets around production, but they're bespoke to our business, and aren't also the kind of assets that could be used to secure a traditional bank loan. And so we had to do a couple pivots. The most important one was that we restructured our business for near-term profitability. So we backburnered a lot of our innovation and a lot of the things that weren't generating revenue for the business, and we really focused on this lab with the consulting services that we have and driving revenues through that. And then we sought bridge financing and we did it in a couple different ways. For existing investors and new investors, we offered convertible equity with a kind of a sweetheart discount to kind of keep the lights on, so to speak, and get some things, keep things moving forward, keep the train on the tracks. And then we also were lucky enough to have met a family office that was willing to give us a private bridge loan specifically to fund some inventory that we had, because we had a large launch coming up, and we didn't have the cash flow to actually produce the product that we needed in order to fulfill that, just based on the challenges I mentioned around long sales cycles and the nature of how revenue flows in the B2B ingredients. Another thing that we did is we started looking for various types of non-dilutive capital and grants to fund some of the research that we're doing, because a big part of our mission is helping get other ingredients commercialized that have the impact that we've been doing with the regrained product. And most recently, we're very grateful and excited about a catalytic grant that was a match grant we received from Beam Circular, in partnership with the Almond Board of California, funding some of the work that we're doing around advancing almond hull-based ingredients. So you've got a plan, but when the plan gets implemented, things don't always come together. And this is a little bit as to how we shifted the way that we think about our business. And so I know we're probably just about at time. Happy to talk with anyone further, but just super grateful to ReFED for everything that ReFED's done over the years, and CapShift for putting on this webinar. Thank you for the opportunity to share our story with you.
Thank you to all the speakers. Thank you, Dan. I am now super hungry due to all those images, so I'm gonna have a snack after this. All right, let's bring everyone back, and we are going to have our Q&A. We got some good questions in the Q&A, some direct messages that I can speak to. And yeah, Dan, if you could just unshare your screen so we can see everyone's lovely.
Yeah, it's what I'm sorry. I'm trying to find the button
No worries,
that
I
did
know
when I went to full screen.
The trickiest
Looks like
part
so.
of
Yeah.
any webinar. Thank you.
There we go.
Okay, awesome. So this first question is for Caroline and Aaron. And Aaron, you spoke to this a little bit, but funding rounds are slowing down. They're taking longer. Government grants, Aaron, you mentioned maybe not as bad of a situation in the US as we all might expect, but still, I would imagine more challenging and just a difficult funding environment, more need competing for less funding. So curious how you've seen the need for bridge financing evolve, and also if you've seen any regional differences, whether in the US or abroad.
Yeah, I think, I think there's been a lot of investor pullback with uncertainty. And so that's actually created even more need for our products. if a government contract is not like explicitly canceled, we're still advancing against it. And so companies are really, further seeing the need for our type of financing, to bridge them to get through this kind of volatile period. So instead, raising their round right now, they're saying, okay, let's execute on this government project or this commercial project and show traction, show that we've completed this using Enduring Planet's capital, and then we'll go back out to the market when it's a little bit more stable.
Yeah, I think, this year has been uncertainty is the word, I guess. The first 2 quarters of the year, things were very much at a pause. I do think that Q3 and now into Q4, we've seen investor activity pick up more. Um, half of our portfolio is in Africa, and the pause from the U.S. government's Development Finance Institution, DFC, has caused just a lot of uncertainty in the market. They had billions of dollars of commitments and have not made many disbursements as they wait for an administrator to get appointed. So that's definitely had a negative impact on the market. I think if you look back, 3 years ago, probably 60 to 70% of Open Roads loans were bridging towards equity rounds. And now we're bridging to more debt. So just speaking to kind of the value of long-term debt in this market too. A lot of that internationally is coming from other development finance institutions, so government entities that are providing longer-term financing. But there's no question that I've shifted from, talking about accelerating impact to holding the line for impact. It's just going to be a time where we're focused on preserving what we can.
Thank you. That makes sense and really shows how bridge financing can tie into funders' other capital deployment strategies and what they themselves see in their portfolios. Speaking of holding impact, so Namika, you spoke a little bit about kind of your funding expectations changing meaningfully and some of the ways you're refocusing your capital. Can you just talk a bit more about like how that funding shift caused you to change operationally, how you're trying to maintain impact amid that challenge, and how the bridge loan can help?
Yeah, the information that our lead investor was having liquidity challenges on their endowment came pretty late, around July. And then we needed to figure out how much more we can run. Basically what we've really done is to increase on our storage capacity across all cold hubs, dropping pricing for daily storage so that we can increase storage across all cold rooms, and also drop prices on our reusable plastic crates, to make sure that we can sell better as we did not plan during the year. And then we've also kept discussions open. Every day I pretty much have one call or two calls with a potential investor. It's very difficult within the space. Most of the bridge financing that we've come across are really short term, and the expectation is that the bridge here is an oncoming additional investment of $2 million from King Philanthropies, but which will occur sometime in late 2026 and 2027. Most of the bridge is within that time frame of 8 months, 9 months. And we are not very sure if the liquidity issues on the endowment will be resolved at that point, But, we are still looking and pushing, and we are still speaking beyond Europe and American investors, looking inwards too, within Nigerian investment space, and speaking to banks and several other venture capitalist firms. Yeah.
Thank you. Fingers crossed. Definitely playing a really important role in the marketplace. Dan, looking backwards, had you not gotten that bridge loan, can you, imagine what might have happened? What else could you have done?
We probably would. So the bridge loan, I guess I'll speak to in this case is the debt that we closed from a family office to help us with cover the orders that we were expecting. And we likely would have had to really reconsider the ingredient business that we were in, and consider a full shift, of some kind to the services model that is, profitable and working and doesn't have, the overhead or the cash flow requirements that the ingredient does. And so we would have, I mean, that would have been like the big picture strategic question we would have been asking ourselves. But in the near term, we would have lost the largest deal of that year that we'd spent the last 2 years working on closing just because of a cash crunch. So it's not just I mean, there's the big stuff, but in the, in the acute, moment of what's going on, at the end of the day, if you can't, if it doesn't matter how long the cycle is, once they're ready to order. And the big challenge in the ingredient space, by the way, is that not only are these sales cycles long and you don't have formal offtake agreements, that one implication of that is they can sometimes come out of nowhere wanting something early or wanting more than they originally expected, or it can be a bit unpredictable. Investors, of course, don't like that, understandably. But as the operator, that's the business we're in. And when it came time to fulfill that order, if we weren't able to do it, we would have lost the account, which has obvious implications.
Yeah, thank you. I'm glad that was a hypothetical, but I think it really does show like how critical that one was. All right, there are more great questions that were in the Q&A box, and Aaron and Caroline have answered in writing, so please take a look. We're fortunately out of time to do a voiceover on those, but I think they're really interesting. What I'd love to do now is we're going to just share my screen here and close us out. Line that up. We're going to ask all of you who are still here, which is most of you luckily, to please just take a moment to fill out a poll for us. This really helps make sure that our content is valuable to you moving forward, gives us feedback, helps us improve. I'm going to play some Hall and Oates to serenade you as you respond to the poll, and then I will close us. All right. Hopefully, some of the funders on the line can make the operators who need bridge financing dreams come true. And with that, just really want to thank Caroline, Aaron, Nalika, and Dan for joining us today. To all of you, especially those who have come out week after week, for taking the time. As always, you'll receive the webinar, the recordings after. You can visit our YouTube channel. I think you all know the drill by now. If ReFED or CapShift can be helpful in any way, truly, please don't hesitate to reach out. And the last thank you I want to send is to my colleagues at ReFED, our partners at CapShift, for making this webinar series possible. If folks didn't get a chance to fill out the poll and want to send additional feedback to us so we can continue to put out content that's truly helpful, please do send that our way. With that, thank you again. We hope everyone has a great rest of the week. Take care.